Good morning, everybody. It's 8:30, and looking at the count, we have a few more people to log on, and then I'll get started in about a minute. All right, we're just about 100 people right now. If you can just do me a favor and type in the question box where you're located. I just want to make sure that you can hear me and that we're getting the questions. Okay, great. Barry, you're one of the first ones to comment all the time. Super. Okay. We're getting responses from people, and a lot of regulars I see up there. Great. Thank you very much, everybody. So I'm going to get this started. I know I said I'd wait a minute, but I know that we have a lot of people on here already, and we have a topic that a lot of people have been asking about, asking a lot of tremendous questions about. It's relating to the PPP, the Payroll Protection Plan. And today, presenting for us, we have Ken Bagner, who's with Sobel & Company. He's presented numerous times. He has extensive experience in accounting, tax, and consulting to his clients. He's been involved with this PPP program probably even before it started. We also have Logan Fisher, who is with Bressler, Amory & Ross, who is in their securities practice group. Logan primarily represents financial services firms and individual brokers and investment advisors. We also have Jeff Berger, who is with Goldenbach. Jeff leads the firm's corporate tax practice. He's involved in structuring many corporate transactions in which the firm is involved, especially in the areas of mergers and acquisitions. Gentlemen, I'd like to thank you for coming today and presenting. Before we get started, we have a couple more housekeeping items. To mention the speakers, Ken will be speaking on forgiveness. Logan will be speaking on some legal aspects and primarily, and Jeff will be talking about return of funds, but they will be interacting amongst themselves and sharing and answering the questions that you have. As it relates to questions, as we go along, I'll be reading the questions and I'll try and summarize them and group them as best possible. If we don't get to your question, we do save them and we try and get to them afterwards. Please, you don't have to keep asking the question over and over. And I do try and give a lot of people, different people, a chance to make sure that they get a question asked. So if you wind up asking 10, we've had people ask over a dozen questions. You might see that I may not be going towards them unless it's point specific. Finally, there's a poll. We will have 4 polling questions. If you attend this to obtain continuing education, you have to answer at least 3 of the polling questions, 75% of the 4. And with that said, we will kick this off. So Ken, I don't know how many people just keep asking the same questions over and over about forgiveness and what are the specific areas they should be focusing on. And it's just so difficult with the lack of guidance that's been provided. And hopefully you can give some clarity as it relates to this.
Sure. Good morning, everybody. The forgiveness issues, the clarity is still not there as much as every single day. Companies across around the country are asking for advice on what to do. Now, I will say this, that what we've been looking at, and there's been online calculators that people have developed, but I called from the payroll end, the payroll companies, ADP, Paychecks, they're all working on programs to work on forgiveness calculations on the payroll end, which I think is the area that is the most complicated. Now, the issue is right now really is how do you spend your funds? That's where you start with. And how are you going to spend your funds is really based on planning. Because remember, from the date you get the disbursement, which most of our clients have received or majority have received disbursements, some have not, but majority have at this point, you have 56 days to spend the money. Now, how you spend that money is based off of your payroll, your other costs, which is also your payroll includes health insurance. It also includes, in addition, that's the employer side, the SUI, SDI, and your 401k/pension plan contributions. So when you put all those together, you can max out at 100 grand. Then you could also have your rent. Your people are asking about mortgage interest. I believe that only relates to, your facility that you have for your business. It's not like credit card interest or anything like that. And your utilities, which include telephone, includes internet, heat, water, electric. So documenting all that, all those expenses and how you're paying them is important. So some of our clients are asking, what do I do? Should I have the separate account because the money goes into a separate bank account and only pay expenses out of there? Here's the problem. The problem is if you're paying your full payroll out of the account, you're probably paying for people who make over $100,000. So some of the money you're paying out isn't appropriate. So I don't know if right now if really tracking out of a particular account makes a difference. I think it's more getting like an ADP or Paychex or whatever other payroll service you're using to generate a report so you could track the forgiveness and take a look at what particularly you're doing. And the biggest thing is really planning right now. So how do you plan for what you are going to spend? Some companies, I've told companies, if you look, 56 days is the period you have to spend the money. The loan was based on roughly 76 days. That's where they come up with roughly 75% should be spent on payroll. Now, should you hire people back just for the sake of hiring people back? Probably not, because most calculators, as we went through with rent, utilities, and paying payroll, even if you paid everybody, there would be a percentage that wasn't forgivable. So why spend the money and lay money out of pocket that you're not going to have forgiven potentially? In addition, besides that, we're talking to clients about really looking at their people who they want to bring back, because you want to be prepared for when we reopen. New Jersey is now extended to June 7th to reopen businesses, and who knows when we'll get back to normal. So there's a whole process that we're going to have to go through until everything gets normalized and we're back to work, so to speak. So looking at what you can do in between now and basically June 7th to get your company ready above the competition. What can you spend on? Are there projects that are in the parking lot that you haven't done in a while that could really help your business? Or the things that you could do now and certain types of marketing you could do now or spend on for your employees to do that will put you ahead of the competition when things reopen? Let the government sponsor those things to help grow your business. But don't hire people back just for hiring people back, because why pay someone to sit at home to do nothing? So that's some of the things that we're talking to our clients about. Our clients are very concerned, obviously, about the coming out with the secretary coming out with potentially having to give back the money. And now they still have not given any real clarification. And I know that we have two attorneys on the call here, Jeff and Logan, which will talk about their views on this. But I will say that right now what we're advising clients to do is kind of still a wait and see approach. There's no right answer here, and it's an individual determination by client whether they feel there's an issue. The guidance they have right now really doesn't show, unless you're like a public company or you're owned by private equity, that the money needs to be returned. But it does talk about liquidity and measuring it, but there's nothing in the guidance that really goes through any certainty on it. It talks about economic uncertainty, that you signed off to make a request for the application. It talks about having substantial or sufficient liquidity that is a manner that will not affect your ongoing operations, a manner that's not significantly detrimental to your business. What that means is very subjective right now. So what we're having our clients do is document their case of why it was necessary to have their money. They have an individual decision, as well as any other company that received the money, to look at that and make their own determination. But right now, still, I think that's why they extended the deadline to give back the money to May 14th, because we're not really sure at this point in time. All based on the guidance that has been given, there's no real ability to make a decision, especially for private companies, because the questions really don't address that very well. I will say this too, the formulas are very, very complicated on, the payroll, and when you start looking into all these things, whether tracking the costs that are up to $100,000, you have to annualize your 8-week period versus your first quarter of 2020. You look at look at the change, whatever's over 25% is reduced from forgiveness. And then you're looking at, in addition, if you offer to hire someone back, but they decide not to come back, it's not a reduction in people. There's full-time equivalent calculations on hours. Anybody who's works basically 30 hours a week is a full-time employee. Everybody else, you should be counting the hours, and you compare it to other periods. So when you start going into all this stuff, and I mean, we could talk about that for a half hour, maybe even an hour, and we still probably won't even understand what's going on. I think that, there's so much stuff floating around here as far as how to do this, what to do. The key is just to know how to really plan right now, how to spend the funds, look at your business, try to get ready to prepare yourself to be ready when everything opens up, to spend the money wisely, and don't overspend money that you shouldn't be spending on employees that are just going to sit around and do absolutely nothing. That would be the advice as of right now. And then as far as giving money back, I think we still need to wait and see for the next 7 days if something comes out that is significantly detrimental to a lot of our clients, and kind of go from there.
There was a question. Thank you for all that. And the problem that is they're giving really no guidance on this completely. They've said it's the 8-week window for incurred and paid, but it doesn't your payroll may not fall exactly into that time frame. And I know that the AICPA, and isn't an AICPA session, is trying to advocate and give guidance to them to say, hey, just capture the particular period of payroll. So they haven't given any guidance as to that I'm aware of. And another thing relating to payroll is somebody asked, I want to make sure that we clarified. You said it's employer portion of state unemployment and disability. It's not employer portion of Social Security and Medicare. By the way, there's a separate program or relief for that too, correct?
Correct. Yeah. So it's not that, but if you haven't received forgiveness on your payroll at this point in time, then you're able to defer your employer side of your Social Security taxes up to the date of forgiveness, and then you could pay those amounts 50% December 31st, 2021, and 50% December 31st, 2022. As far as the other things, as far as capturing, right now we believe that it's probably going to be for the payroll, it's going to be what you pay people during the period. You look at your pay dates, obviously, and do you do a final pay date before the 56 days are over, potentially. For the other expenses like rent and utilities, I think it's kind of a paid and accrued method, because people are going to try to push their rent through in a 56-day period, and they might prepay. So I think what I've read, and I've seen, is that they're going to put up guidance that you could pay it, but you also have to look at the days of rent based on your contract. That's why they're asking for the contracts in place before 2/15. The A, see you have a contract, and to B, to see that you're not overpaying the rent based on that contract. So that's my thought on the rent and the utility side and other expenditures.
Okay. So we have a lot of questions that already came in, but I want to just jump to another topic. And after Jeff and Logan have spoke, or Logan and Jeff, we got a bunch of questions as specifically as is real estate taxes included? To give you some chance to think about it, are real estate taxes included? Is health insurance part of the 10%? So we'll get to a little bit more of those in a while. So as everybody's trying to digest what Ken just said and trying to make sense of it all, Logan, what are the legal aspects of everything that Treasury's been putting out there? What warnings, that's a tough word, caution signs can you put up for everybody?
Sure. Thanks, Brad. Thanks for having me this morning, and good morning to everyone. So yeah, so now that everyone has spent the last month, basically trying to get a PPP loan, the hot topic now is whether or not you should give it back. The focus really has been due to a lot of the recent news stories that certain large, sometimes publicly traded corporations have been receiving PPP loans, the Shake Shacks and Ruth's Chris and companies like that, and as Ken mentioned, in the initial loan application, businesses simply had to certify in good faith that the uncertainty of the current economic conditions made necessary the loan request in order to support ongoing operations. And, I think we can all agree that that's a pretty broad standard. And, unless you're a grocery store or an Amazon, you really had no problem making that initial certification with a straight face. So now that over 350 billion in money has already been dispersed, the Treasury is starting to backtrack a little bit and give us some additional guidance. And as Ken mentioned, with the release of the FAQ 31, which came out towards the end of April, the language of that, it instructs all PPP borrowers to, it says, quote, to take into account their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to their business. So let's unpack that a bit. This language, I think when it came out, was initially problematic for a lot of people because the CARES Act had suspended the ordinary requirement that borrowers must first be able to see if they can obtain credit elsewhere. So now you have this guidance that comes out and says if you have other sources of liquidity, that's something you need to consider. And we have a lot of businesses, I'm sure a lot that are on this webinar this morning saying, well, we have enough cash on hand for a few weeks or maybe a few months or maybe through the rest of the year, but not for a period much longer than that. So does this mean that we have another source of liquidity and therefore we don't qualify for a PPP loan? Or you have a lot of businesses, I'm sure many on this call this morning, that have access to a line of credit, but is the Treasury now saying that you first have to exhaust your line of credit and go heavily into debt before taking PPP money? And, as Ken mentioned, unfortunately, the answers to these questions are very unclear at this point. The Treasury indicated on Tuesday, this past Tuesday, that they're going to be releasing new guidance before May 14th. So as Ken mentioned, I definitely recommend staying on top of this, taking a wait and see approach. We'll see what comes out before the 14th. In my mind, using up your cash reserves or going out substantially on a line of credit and incurring all this debt would certainly meet the substantially detrimental language that they have in the guidance that's been released so far. So, I don't think that's quite what the Treasury had intended. Another big legal issue, a related legal issue, actually goes back to the original certification that everyone signed when you applied for the loan, which said that the uncertainty of economic conditions makes necessary the loan request to support ongoing operations. And I highlighted the word necessary, because that's a very tricky word. That could be a whole week of law school talking about what the heck the word necessary means. Does it mean it's necessary for you to get the loan, otherwise you're going to go out of business? Is that what the word necessary means? So I think, in the short term, until we get the guidance, the additional guidance from the Treasury, I think everyone really needs to do a deep analysis of your current business in terms of how your revenues and expenses have been affected. And, you really need to be able to conclude, I think, with a great degree of confidence that, that your revenues have been affected or that your expenses have gone up and that you've really been significantly impacted by the current COVID environment. If you're the type of business. Yes.
On that point, just want to highlight one thing. Not all businesses work on a cash method of accounting where, or their business, the cash flow comes in the day they do the work. So we have a lot of distributors, manufacturers on the call here where they may have had large billings and the billings are all coming in now. They're collecting money. They may collect a little bit less because less people are paying, but it's possible. But this trickle effect may not happen until July, August, September, for them. So how do you track to show that you had uncertainty and it was necessary, so to speak, the word necessary, based off of that, because their numbers may be great still, but that doesn't mean they have no pipeline. That doesn't mean they have to start, they're going to have to continue to pay people, with less pipeline if they want to receive forgiveness coming up soon, but it may not even affect them to the back end.
Sure. Yeah, Ken, you're absolutely right on that. I'm part of a law firm. We had the same issue. We had a good April, even though we're all sitting at home here. But we were getting paid in April for the bills that were generated largely in January and February, and part of March. So you're absolutely right. The receipts coming in the door are not necessarily indicative of your current financial situation. I think looking at in an instance like that, I think looking at another metric like sales, what you're currently doing in terms of sales is probably a better way to look at it.
So thank you, Logan. Somebody remind me, thank you very much. I forgot to put up the initial poll, so I want to put that up real quick. Documentation is critical. What type of documentation have you been pulling together? So you should see the poll. We leave it open for about a minute. One of the questions that was asked while the poll is going up is if some of the people they put on or went on to unemployment, but because of the fantastic way the unemployment system is working, they haven't gotten their benefits. Can they back pay those people? Do you know? And now my concern is that, I don't know if Logan, if you can answer if that's legal or more tax related. My concern is that if they do back pay them and then they get their unemployment benefits, then they have a problem they should not have collected those benefits. Correct?
That was my initial concern when you read the question.
Okay.
Mm-hmm. Now I will say there was a new PPP guidance question that says if you try to hire someone back and they're not coming back because unemployment's paying them more, if you get written documentation of that, then that doesn't count as a reduction in workforce, and you can add that person back, just so everybody on the call knows that.
Okay. So real quick, I just want to say to Colleen, we're still getting comments about people not being able to activate the poll or to hit the poll. But 79% of the people that could vote said that they're keeping all of the above: financial reports, payroll reports, etc. I'm going to try just real quick one more poll, and Ken, I want to ask you a question, and then Jeff, we are going to go to you. I know you're sitting there anxious, Jeff, saying, when are they getting to me? But quick more poll, I want to see if people can answer it. When you applied for the PPP funds, was your bank very helpful, somewhat helpful, never returned calls? I had no reason since, no response since I applied. Ken, one of the things that people seem to be confused about is the 75% of payroll. You said at least 75% has to be used on payroll, or another way to look at it is the rent and utilities is maxed at 25%. They seem to think that they can only spend 75% on payroll. That's not accurate, correct?
That's not accurate. Listen, money is kind of fungible here. This whole thing is kind of, you take kind of whatever you're spending. I think when you're applying, when the bank is going to ask you for, they're going to give you a forgiveness application. And I can't say based on the applications we received to originally apply for loans, every bank was different. The forgiveness may be different unless we get very clear guidance of an application for forgiveness. You're going to put down how much payroll costs you had, how much rent and utilities. The key here is, and this is the way I read the law, is that you can't have more than 25% rent, utilities, mortgage, interest, which are other expenses besides payroll, on that application to get forgiveness. Otherwise, you won't receive forgiveness on that percentage. And the reason why that they put that in is this program was intended to keep people employed. It wasn't intended for overhead expenses to pay and not pay employees. They wanted to keep people at work. And they also envision, I think, probably companies being kind of using some ingenuity to pay their rent, more than they normally would, and all the other things. Think about related party companies, so they're going to have rules related to that. But your application, you're not looking at your dollars and saying, okay, I spent rent, I spent utilities, and I spent payroll, and payroll's not 75%, so I don't get any forgiveness. I think you take your payroll that you spent, put it down, and then when you mathematically, your rent and utilities can't be more than 25% of that total number, all in. Otherwise, you won't receive some of the rent and utilities forgiven and mortgage interest.
It's important what you said, Ken, is that this is intended for payroll purposes, rent and utilities, not for all other aspects of operations, which Jeff goes into the whole, I know Logan talked about the legal aspect, but the need, and that's where this whole need, I put in quotes, came up. And, they gave us till May 7th, where that date came from, we don't know. But now all of a sudden they extended to May 14th. What should people be doing it between now and May 14th if they haven't done it already?
A lot of things, I think. But before I get there, let me just kind of expand a little bit on what Ken was saying, and highlight a little bit of the confusion also. The guidance seems to have two different tests. One of those tests, and based on what the words in the statute say, that for you've got to spend that for forgiveness purposes, 75% of what you spend that is forgiven must be on payroll costs, which includes healthcare as well as just the salary and that sort of thing. The permissible payroll cost things capped at 100,000. So if you borrow 100 and you spend 30 on payroll costs, you can have up to an additional 10 on rent, utilities, and the other permissible expenses forgiven, for a total of 40 forgiven. The other 60, theoretically under the statute, you could use for beyond the 8-week period for anything necessarily you want. It's not going to be forgiven because you've spent it beyond the 8-week period, but as long as you spend it on rent, utilities, payroll, etc., within the before the loan has to be repaid, that you're not violating any rules. The guidance that came out subsequent to the enactment of the law went on to say that you have to use 75% of the loan proceeds for payroll costs. That's a different test than the forgiveness test, which seems to be based on 75% of the amount forgiven has to be for payroll costs. The guidance, which is not part of the law, says now 75% of the loan proceeds have to be used for payroll costs. Doesn't say when you have to use it. So again, you could theoretically, and if you are, for example, a restaurant and you're closed now, and so you've laid off all your employees, as others have said on this call, it may not make a lot of sense to rehire them simply to pay them to get loan forgiven, especially when some of them are probably making more collecting unemployment right now, especially the back of the house people. But the trick is, what happens if you don't use at least 75% of the loan proceeds for payroll costs? And the fear is, if you read the guidance literally, that you don't get anything forgiven. So in my example before, where you've spent $40 of your 60 within the 8-week period, and you apply to have that forgiven, does the government wait and see whether what you do with the next $35 before they decide whether to forgive? Because again, the guidance says you have to spend 75% of the loan proceeds on payroll costs, or you've got to repay the loan. So it's unclear. Nobody is sure of that, and it's just among the dozens of things that seem unclear in these rules, and in particular in the forgiveness area. Everybody's waiting to see what the guidance is, and of course, as we have seen from the past guidance, once the guidance comes out, there's they answer, they raise as many questions as they answer.
So Jeff, you're saying that, like, in reality, businesses that don't really come back may really have a problem with this. Businesses that continue on, and when things reopen, you could pretty much designate your funds whatever you want, because it's not like funds are all commingled really in reality. So as long as you spend up to 75% on payroll, who knows how they're going to measure that? Those businesses are going to be okay, but the ones that don't come back may have a real problem with this provision, potentially, depending on right now as the way the guidance stands.
And that gets to the next question, because I think this is all related. You're making a good faith determination when you apply for the loan, that you need the loan, and you're committing to spend when you apply for the loan. You're committing to spend the money on payroll costs and other permissible expenses. Again, if you have no employees now because you're not permitted to open, I think what we're seeing and most of our clients are doing is they're just waiting. They're sitting with the money and they're waiting. And if and when they can open, they will spend it on the permissible uses. In the meantime, they've got, because they're not paying payroll, perhaps they have other money available to do various other things that they can do, and that's certainly fine. But the government will want to see that you made a good faith commitment and intended at the time you got the loan to spend this money primarily on employee retention, but with additional amounts available for rent and utilities and the like. So now, when you get to the question of what do you do to protect yourself from the possibility that the government's going to come back, especially if you've gotten a loan in excess of $2 million, but really that doesn't matter. That's just a question of whether you're going to get specifically reviewed or, as Mnuchin said, audited. What we're telling all of our clients is that they should take meticulous care to create contemporaneous, that means now, documentation of why they need the money, including coming up with budgets, projections, having all this in writing. If your business has a board, having this presented to the board so that you can prove that right now you believe that this money is necessary. While they've eliminated the credit elsewhere standard, and they've introduced these other ideas about liquidity and all, the issue is, I think what you need to do is you need to determine whether or not, if you have room under your line, whether drawing on that line would significantly affect and adversely affect the business or not. Whether there are other financing opportunities available to you. Obviously, if you're a public company, you're going to have a hard time with this requirement. But even as a private company, they're going to be looking at what are your liquid assets, what are your other sources of revenue, of financing, whether that's debt or equity, and whether you can get that on any kind of commercially reasonable basis and on a basis that won't cripple the company. And when you're thinking about crippling the company, or you're thinking about applying this standard generally, that you're not to adversely or significantly affect the business. I think the key thing to keep in mind is employee retention. This whole program is designed for employee retention. So if you go to a bank and the bank says, look, we will lend you money, but you've got to lay off 20% of your workforce, it's pretty good evidence that's the kind of response you want to document. And then you don't take that loan, you have some good proof that it was necessary to get the government money because you're trying not to lay people off. So that's another aspect of what you should do. the whole decision-making process should be documented. You should be putting down on a piece of paper now your reasons why you're applying for this loan, your reasons why you don't think you can get the money elsewhere in a manner that won't significantly detrimental to your business.
So, I mean, the questions that have been coming in, the questions that have been discussed, a lot of times relate around either the credit line, a line of credit, or owner's ability. And Ken started touching on it before. You know, we have clients and there are companies out there that say, okay, I would have laid people off, but not for that. I kept them on using the PPP funds, and I can document that. Now, if I had a credit facility available, why should I use my credit facility to pay the people? And then when the 8 weeks is gone, PPP is not here, I don't have a credit facility now because I've used it up already.
Yeah,
All of that type of stuff should be documented, right?
It's got to be documented. It's got to be built into your model. If you're modeling out, you make assumptions as to when you think you may be able to open. You make assumptions about how much your burn rate is on cash, how much you can draw down on your line, and whether or not you have enough cash to sustain the business. I mean, the game is survival here. Everybody's trying to survive until things get back to whatever the new normal is. And if you make your assessment that if I draw all my line down now, and I cut my costs as best I can without cutting payroll, and I still feel like I'm going to run out of money by the end of August, seems like you got a good argument for taking the loan, especially if you think that you're not going to get back up to normalcy until November or December or sometime next year.
Right.
This issue comes up in lots of contexts. What happens if you've got very wealthy owners? What happens if you're a private equity owned business and the fund itself has a lot of dry powder, which means, you know, they have the ability to draw capital, to call for capital contributions from their investors that has been committed, capital that's been committed but hasn't been called yet. And these are tough questions. There are no easy answers. Our view on the latter, on the fund side, is that the funds themselves have fiduciary obligations to not only their investors but also to the creditors of all of their portfolio companies, and the fund can't be expected to spend every last dollar it has to sustain a business that may not make it anyway, and pulling down capital calls that could otherwise be used for other investments and the like, because they have to factor in the larger responsibility the fund has to its other portfolio companies and its investors. For privately held businesses that have wealthy owners, it's a challenge. It's not, I don't have a lot of insight into that. I would think that if an owner has capacity to put more money in, that ought to be analyzed based on what are commercially reasonable terms on which that money would go in. And that doesn't mean you've got to put money in at a 1% interest rate like the government's willing to do. It seems like you'd figure out what is the current market rate. You would probably want to do it as a loan. Of course, you then have to factor in, well, if we borrow money, if the company or the business borrows money from me, the owner, or from any other third party, what does that do to my existing debt facilities? And am I violating my existing loan covenants? And what will my lenders say about that? Will I be able to get my lenders to permit an additional financing if the new financing is deeply subordinated? And if my current lenders would say, yes, you can go borrow from either yourself or some third party, as long as the new facility is deeply subordinate to the existing facility, that's going to affect the interest rate that a market interest rate that I would charge, and maybe I end up having to charge 8 or 10 or 12% interest because I'm so far subordinated. In which case, I don't think my company can match can make the debt service. All of that you need to document. You need to run those numbers. You need to talk to your accountants and let them help you figure out, how to model this. But do it now. Don't wait.
Yeah, I mean, it comes down to really documenting. That's what I've been saying. And somebody asked a question, if I'm down 10%, can I keep the loan? And on the surface, you can't say that because there's a lot of things you have to consider. And the one thing that I've been expressing to people also, and you tell me if I'm wrong, is that you can't just look at the 8 weeks. You have to anticipate, as you said, when you and your company are going to return to normal, and what is it going to take for you to get there.
That is absolutely part of the analysis.
And the irony of this is the government has the ability to Monday morning quarterback on all this, right? So, they could look back and say, well, why could you? Well, we didn't know. I mean, New Jersey, for example, has been shut down. Now it's going to be shut down for 3 months. Who knows if we're going to be shut down even further? And the other part about this is the companies that were basically almost out of business, they definitely won't have a problem documenting why they needed the funds. So is that a prudent way that the government really wanted to give funds to companies that either were already mismanaging their finances or personally taking money out for their own benefit and not, keeping their company solvent? I don't think that was their intention. The intention of the program was to make sure people stay employed. So that's another part of this, but especially in the area that most of our people on the call here live in, which is the tri-state area, we're the hardest hit area in the whole entire nation right now, and maybe the last ones to open back up.
Yeah, and I'm going to launch a poll. I'm going to launch a poll real quick. And my satirical comment to what you just said, Ken, it really dawned on me. I'll be happy to tell the government by May 14th if I don't need the money, if my governor will tell me by May 14th when we can go back to work.
So the May 14th is the new deadline that came out a couple days ago, with the promise that before then we'll get additional guidance on this issue as to eligibility and necessity for the loan. So we're all anxiously waiting for that additional news. One other thing, Ken, that you mentioned that reminded me that I should mention is that it would not be a good look if you're paying yourself dividends now in excess of perhaps tax dividends, what you need to pay your taxes, or if you're embarking on acquisitions, or if you're spending enormous amounts on CapEx or on new business line startup costs. All in context. Obviously, there's some circumstances where that makes a lot of sense, but you got to not only look at what your sources of revenue are, but also where are you spending your money. As Ken says, money is fungible, but if you're spending wildly, or if you're not being prudent about what you can cut back on, and then getting the government money, that itself could be a consideration. One other thing to note, just to cover one other point. I am told that there are now 2 senators and 1 congressperson that are on board with the idea of changing this 8-week period for businesses that either are currently closed or adjusting it for, as the AICPA wants to do, for your payroll periods. The interesting thing is that while there's been an enormous amount of clamoring about this issue, to date, there has been nobody in Congress that's gone on record about this. And what I'm hearing is from an industry group that is a very large industry group that's lobbying Congress, that have been told informally that they've got some support. But interestingly, still, there has not been a single politician that's come out on record. So, who knows where this is going.
One thing also I heard on the news 2 days ago is that originally when they set this bill out, it was supposed to be the whole income, the money coming in that's being forgiven would be non-taxable. But then the IRS came back and said, well, that's great. You can't deduct any of the expenses based on our rules. And they put out a whole like 10-page ruling on this to discuss that it can't be deducted. There's a lot of traction in Congress to say, IRS, you're incorrect, both on the Democrat and Republican side. This, whatever gets forgiven is going to be also allowed to be deducted as expenses. They're looking at the next bill to pass to put that provision in to allow all the expenses to be deductible of what's forgiven.
There was actually legislation introduced yesterday, a Senate bill introduced yesterday by a bipartisan bill by Grassley and others. So they didn't even wait for the next funding. And they're happy, by the way, if the IRS corrects what they say, corrects their latest announcement to change it back. Mnuchin was the one that came out and said, yes, it should not be deductible. And then these senators have now introduced this legislation. So more to come.
All right, I gotta launch the next poll. And Ken, while I launch the next poll, I'm going to start going over some of the questions. A lot of them are coming in. If you can kind of reduce what you type, because if it's really long, it's hard for me to try and decipher your question. I appreciate your stories, though. They're compelling. Ken, as it relates to the occupancy costs, we know that they said rent and utilities, which they incorporate phone and internet. Are real estate taxes, if I have a triple net lease, how should people be focusing on that?
Yeah, I don't think the intention at this point, I haven't seen anything that says real estate taxes or any other expenses are going to be allowed in this, but that doesn't mean that they come out with definitions, which they haven't done yet on any of these expenditures, because some of our clients are saying, okay, internet's allowed, so is IT services allowed? I said, I don't know if you could stretch it to IT services. So again, I'm going to go back to a wait and see approach, because we've been waiting for weeks now, almost a month, for guidance on what does forgiveness costs really mean, if they could define each and every one. And it's very broad. So for now, I would say they're probably excluded unless we hear that they're included.
Yeah, I mean, I searched the FAQs last night, just, did a word search for real estate taxes, and they don't even include that in there. So I'm not saying that it's not allowed, but they're just giving no guidance right now. Our recommendation, for the most part, Ken, tell me if I'm wrong, is that you should keep track of it, and if we find out later on, then that you're going to need it, you can use it, then great. As it relates to keeping track of documents, the questions come in. I don't know if we know this. The audit trail, when they come back in and either they audit for the over 2 million or they have forgiveness issues, do we know what they're going to expect? Do you have to have, what type of documentation should you be ready to provide to them?
Yeah, so some things. One is payroll companies, I believe, should develop reports both on hours of employees and then also on the amount of money that you spent during the period, hopefully limiting the cap to 100 grand. So the payroll reports are going to be very important. They may want to see the bank statements that the money actually cleared your bank account. They want to see rent contracts before February 15th. I would save all your invoices and payments and bank statements related to the payments actually going out for your utilities, for your rent, for your mortgage interest, or any other expenses, with utilities, telephone, water, heat, electric, internet, and get the whole entire file together and separately account for all these expenses to make sure that you have them all together as far as bringing your case together when the bank does ask for the forms for forgiveness, because each bank is going to review it first, and then if you're over 2 million, you're also going to get reviewed by the government.
Right. So let's see, audit support. One of the questions that come in, this is off topic, but I'm just trying to make sure I get a lot of questions asked, is somebody received the funds from, and there are other programs out there, Main Street Lending, the EIDL was one of the initial that came out. and they received funding from the EIDL grant and are looking for the PPP. How do the offsets happen there? If you can just marry up these two plans. And Logan, if you have familiarity with the EIDL.
I do. I could answer that unless Logan wants to take it. It's up to you, Logan.
No, go ahead, Ken.
Yeah, so the EIDL program originally, a lot of people, they said within 3 days they'll get $10,000 as a grant money. That money gets applied against forgiveness, so you have to be careful on that portion of it. You cannot use, if you received EIDL money, you can't use that for the same purposes as the PPP money. That's a 30-year, I believe, around 4.25% or so loan. I could be a little bit off there. If your bank financing is higher than that, what you can take that money to use it for is to sweep it out and pay off that bank loan or pay down your bank loan. And that's a allowed use of the EIDL money. But you can't use it for payroll, same payroll expenses. You can't use it for the same rent expenses. You can't use it for the same utility expenses. There's guidelines on that money on how you could use it, but the most common approach is to pay off other debt, to bring it to a lower interest rate, and then have that debt that you have standing at a 30-year period, because remember, it's a 30-year debt. And as far as the Main Street loans as well, you could take those out as well. On those loans, you have to have, most of the requirements are 6 times EBITDA less the debt you already have. So if you have no EBITDA, you can't take out a Main Street loan. If you have EBITDA, you have to look at what 6 times EBITDA is, and then reduce out your debt facilities that you already have and all your debt on your books in order to get what might be available for a loan. So you may qualify for that. Those programs are good as well, because I believe there's a year deferment of payments, and I think it's a 4-year loan on that program, so you can utilize that money to refinance other debt as well. So I think what's helpful in the other 2 programs besides PPP is using the money to refinance potentially higher cost debt.
Great. So there still seems to be some confusion as it relates to the payroll periods. I'm going to try and encompass it all into one, and I don't know if people can provide clarity on this. What constitutes the 100,000? Does it include health insurance, payroll costs, employer's portion of health insurance, retirement benefits, or do you have 100,000 of payroll costs plus? Jeff,
So
please.
the answer is the 100,000 cap is essentially on the cash compensation. It's salary, and I guess there was one clarification where if you're, I forget what it said, something about paying off student loans or something. I forget one thing, but essentially it's just your cash compensation. So if you've got an employee that earns, whose salary and or bonus and or commissions collectively exceed $100,000, you cap them at $83.33 a month, and that you can then add the amount the employer pays toward health insurance and these various other expenditures.
Okay, and now for self-employed individuals.
I would just add one thing. If you're self-employed, maybe that's where you were going, Brad. If you're self-employed,
because Ron has asked the question every week around 4 times, so I want to make sure he gets his answer.
So as best I can tell, if you're self-employed and you are you're reporting your income on a Schedule C, you can use up to you can use 8/52, the fraction of 8 over 52 multiplied by your 2019 net income that you report on Schedule C. That's the forgiveness cap. The question is, and the ambiguity relates to whether you can then add additional amounts for rent and benefits and various other things, whether that's part of what can be forgiven. as best I can tell, if you deducted those items, those kinds of items, and to the extent you deducted them in 2019, you can then use them and have a forgiveness amount for the same amounts in the 8-week period. Ken, I don't know if you have a different take on it. There's some ambiguity there based on the interim final rules and the FAQs.
Well, the self-employed individuals that are doing Schedule C, non-partners, they were only allowed to take a loan up to the 852s. They weren't allowed to take a loan with the 401k portion or the health insurance. Originally, we thought they were, and some people may have gotten a loan until more guidance came out that capped that at basically 100 grand divided by 52 times by 8. But on the forgiveness piece, to your point, Jeff, I haven't seen guidance opposing, the rent and utilities applied against, plus how you even calculate what you're paying yourself and how you're earning money. I guess we'll have to look through that part for the self-employed, but forgiveness is different than apparently the loan amount potentially.
So I thought the loan amount was 2.5 times your average monthly.
Yeah.
So you calculate
correct. You're right. It was 2.5 times. I apologize. The forgiveness amount to 8 weeks. Yes.
Right.
But the point was it was capped on the 401k and the health insurance. You weren't allowed to add that portion for the self-employed.
That's okay. But rent and utilities and mortgage interest, et cetera, you may be able to get forgiven too if you had deducted those items in 2019 on your Schedule C. I think that's where I'm coming up. But I think you're right. You don't get the health insurance and the like for forgiveness. Can't include that.
So now we discussed self-employed. What about partner? And you may say, Brad, you're an accountant, so partner is self-employed. But what about partner distributions or shareholder distributions? Have they addressed that at all too?
Yeah, they have. With partners of partnerships, again, I think for the partners, you only get in terms of what you can borrow, 2.5 times their average monthly compensation in either the trailing 12 months or for most people, I think they ended up using 2019 as average comp over 2019. And you don't include health insurance and the like for the partners. For the employees of the partnership, those individuals that aren't getting K1s, that are getting W2s, I think you can include the health and other benefits. And then I think with S-Corps, it just follows the regular rules. Everybody's a shareholder and everybody's getting a W2, presumably. And you've got to work it off. Your loan eligibility and your forgiveness is based on your W2 amounts, which may, in some cases, hurt S-Corp shareholders who have, obviously a lot more income that from dividends. But again, I defer to Ken and Logan if you have more insight on the S-Corp rules, because I'm not sure that I have looked at those as closely.
The S-Corp rules are based on you're an employee and everybody's an employee, so it's the wages plus the health insurance plus the pension, as an employee. The distributions aren't really accounted for.
Now, you mentioned employee, FTE, full-time equivalent. People are asking about part-time employees, how they're counted, if they're added up in any particular way. I don't know if you want to give any, if you have any guidance to give to them on that. If I can look at the exact question, somebody asked, how do you count part-time employees? 3 people working 10 hours each. Does that count as 1 employee? If we furlough or terminate 10% of employees, do we have to forgive? Okay, that's a different question. Sorry.
The answer is yes, and we can move on.
Okay.
No, it's 30 hours a week equals 1 full-time employee is what we understand right now by common definition. So you add up all your part-times to get to a full-time equivalent, and that equals your full-time equivalent, which is interesting because I believe the application was based on head count, not based on FTE, but now the forgiveness is based on FTE periods, and there's periods to look at. So you
Right,
have to add that up.
For the 500 employee test for whether you qualify in the first place, you count those 3 part-timers as 3 employees. But in terms of the forgiveness side, the conventional wisdom at the moment is that there's anybody who works at least 30 hours a week is counted as a full-time employee, and anybody that works under 30 hours a week, you add up their hours with all the other under 30s and divide by 30, and you come up with your number of full-time equivalents. If somebody works 80 hours a week, they are just 1 full-time equivalent, even though they work more than 40 hours. So, it's just the ones that work under 30 are aggregated. This is all based on the Affordable Care Act definition of full-time equivalent. The statute, the CARES Act, does not reference or does not define full-time equivalent, other than in a different context, not relating to the PPP, where it does reference not full-time equivalent, but full-time employees, and then it cross-references to a section of the tax code that was put in place as a result of the Affordable Care Act and uses that 30-hour test. So that's that basis for why everybody believes.
So in the end, they decide to merge everything together and let us, the accountants and attorneys, to deal with it, right? And give advice. So we've hit the 9:30 mark, and I want to respect people's time, your time, of course, the presenters, for coming on here, and the people that are attending. I know that some people have to leave, but there's so many more questions. What's going to happen is we take this list of questions and we try and answer them ourselves and provide them to the presenters so that they can answer them if they see information. For those people that said that they couldn't answer the polls, we're going to have one more poll going. If you can answer it, we will work on getting you the CPE. So I will put the poll up real quick. Have you developed a back to work program? As the poll is being run, I want to thank the presenters, Ken, Logan, and Jeff. But I do want to give the presenters, Ken, Logan, and Jeff, in that order, an opportunity to give one last words of wisdom that you could possibly help guide people anymore. I'll close down the poll so that they could see you. Give me 1 second. Looks like 55 are working on their back to work program. 16% said no, waiting on New Jersey recommendation. 20 don't need one. So I always find it interesting. The people that are attending these that didn't need PPP, don't need a program. So I guess they just like seeing us, Ken. That's what it comes down to. But Ken, Jeff, and Logan, I'm going to put up your contact information too while you're giving your last words. But any thoughts that can help people out?
I would say don't overthink this process right now. There's not enough guidance on everything still. That they've really kind of botched up this program in a way, the rollout, because it was done so quickly. Spend the money prudently that you've received and make sure that it's used to look for your long-term future, not only keeping your operations alive right now, but for long-term purposes to create value in the future for your company, and just focus on that. All the other pieces will come into place as far as forgiveness and how everything works out. And then, as Jeff mentioned, really document your story in a right and effective way. And if you need help to document that story, we're all here to help you, because that's a very important aspect of this. And that's something you should do now. But as far as the other pieces, don't worry about it so much and don't stress over it until we have more information and guidance.
Great, thank you. Logan.
Yeah, no, Ken, that was fantastic advice. I would echo everything you just said. In terms of forgiveness, because I know that's big on everyone's mind. Again, don't overthink it, but I think you would be prudent to start to gather together some of the information, or at least sit down and think about what you're going to need in terms of documentation, just so you're a little bit ahead of the curve. And then obviously, keep checking the guidance. Hopefully one of these days we get a little bit more guidance from the Treasury.
Right. Jeff?
And again, I agree with what everyone else has said. We need to wait and see what this guidance is, but don't wait to start your documentation process. And keep the following in mind, without trying to get people terribly paranoid. This is not something necessarily that you want to play the audit lottery with. Although the size of the amount that you borrow may well factor into whether or not you get audited, you need to know a couple of things. One, the federal government is still investigating people for the 2008 TARP program. So we're 12 years later, and there are still ongoing investigations involving that. The statute of limitations for criminal fraud is 10 years. And so there's a long time. And then finally, there is a growing area of in the legal world for private actions that people are bringing on behalf of the government to enforce government rules. These are called qui tam suits. And it is likely that there will be a whole bunch of lawyers out there that are going to be looking for plaintiffs who are private individuals to chase down and essentially do these audits themselves as best they can of private companies that have borrowed. The list of borrowers is going to get out. I think everybody is pretty certain that at some point or another, all the identity of the borrowers will get out. So, and if that happens, there will be people out there, just like they're out there now suing restaurants for ADA accessibility, or suing your business for ADA accessibility because your website doesn't properly, do things that it should do. They look for, some of those are legitimate and some of those are kind of ambulance chasers, but they look for these things. Get yourself documented.
Thank you very much. Thank you. You answered one of the questions too, so that helped out. So I want to thank everybody again for attending. Next week, we will have two different sessions. I know that there are probably some nonprofit people on here on November. That's what it feels like working at home. It's been that long. On May 13th, we will have a nonprofit session on during this whole COVID environment. And on May 14th, the next day, Thursday, we will have another CFO roundtable. If you have any particular topics that you would like to hear about, please feel free to submit them. We do try and aim towards what is of interest of the people. Again, Logan, Jeff, and Ken, thank you very much for presenting. You've blown my mind, and I'm sure everybody else is just, thank you very much. So,
Thank you.
have a good day.
Thank you.
Thanks for having me. Appreciate it.
Bye-bye.
Bye.